Are you ready? Okay, here we go. Let me get things started here, folks. So first off, thanks for joining me tonight. Appreciate you being here. I'm Adam Von Romer, author, speaker, seminar leader, 32-year veteran of the commercial investment real estate world, and founder of the Commercial Investment Real Estate Academy. And one of my favorite expressions is by Josh Billings, the old Western satirist, and he said, "It's not that people don't know, it's just they know so much that just ain't so." So what I want to do is I want to kind of tell you a little bit about capital gains tonight and walk through that process. And at the end of the night, I'll hang out for a couple of minutes. If you've got any questions or comments, please feel free to type away in that bottom line, and I'd be glad to answer them for you. And certainly, hopefully I'm going to demystify the process for you. So hang out, here we go. And you're going to like the first one. First off, I thought I'd look up some definitions for us to kind of give us a handle on what capital gains is or isn't. And I like this one. It says a capital gain tax is a type of tax levied on capital gains incurred by individuals and corporations. Now, I guess nobody ever told them you don't use the term you're trying to define in the definition of the term. To make it really easy, what you need to think about when we're talking about capital gains is you buy an asset, any asset for that matter, at a price. And let's call that price for our illustration tonight $1 million. Anytime you sell that asset for more than what you paid for it, under most circumstances, that is going to be called a capital gain. And we're going to talk about some refinements here in a minute. But generally speaking, if you bought it for $1 million and you sold it for more than $1 million, that's a capital gain. Now, I'm not going to get into parsing what goes into capital gains tonight. I'm not going to talk about commissions and appraisals and bank points and fees and things like that. We're just going to keep it simple. $1 million goes into the investment. We're going to sell it later on at a profit or a capital gain. And we're going to dissect and kind of identify the taxes that would be owed. And I'm not trying to make you a tax attorney or an accountant here. I just want you to be aware of it so that as you move forward, you can understand some of the potential exposure that your clients might have as you're going through this process. So again, the capital gain, you buy an asset for $1 million, you sell it for more. That more is basically your capital gain. Now, the next one we got to really talk about is basis. And for some reason, they like to define everything in terms of a home. But simply put, basis is the amount of money that you paid to buy that particular asset. And again, I'm not talking about the sales expenses and commissions and all that stuff. For our purposes tonight, we're going to buy an investment. We're going to pay $1 million for that investment. And that's really going to be our basis. That's it. We're going to buy it for $1 million, and that's our basis. Now, briefly, and I'm going to show you on a slide later about what's called adjusted basis. An adjusted basis is nothing more than our basis plus any major capital improvements that we make to the property while we owned it. So in the example I'm going to talk about later on, we bought our asset for $1 million, and at some point in time in our ownership, we put another $250,000 into the property. Could have been capital improvements, roof, site improvements. It could have been a new envelope on the outside of the building. Whatever it is, we're not going to deep dive into that tonight. But just understand that we put another $250,000 in it, and now our adjusted basis at sale is going to be 1.25. And I'll show you that on one of our later slides. And now one of our last vestiges of tax savings here is recapture tax. Now this used to be known as depreciation, and what it enables you to do is deduct a portion of the improvements over the life of the property and your ownership interest. So if you're basically leasing or owning a commercial property, you get to deduct the cost basis of the improvements over 39 years. And if you're doing a multifamily property, which they call residential, you get to do it over 27 years. Now, we're not talking about residential like houses. We're talking about multifamily buildings of 5 units or more. So if you buy a shopping center, you buy a warehouse, you buy an office building, your depreciation schedule is 39.5 years. And if you buy a multifamily or an apartment building, your depreciation schedule is 27 years. And we're not going to get into the mid-year convention or any of that stuff. That's something that you really need to look at, later on in a CCIM class or something like that. So here's our first slide on what our capital gain is going to look like. Here's our investment. We're going to go ahead and buy this asset, this building, for $1 million. Now, on the left-hand side of the screen, you see where I put dollars invested. And our our basis is going to be $1 million for this illustration. At the bottom of the illustration, we have time. And don't fixate on how long we're holding it. Just follow me here. So we buy this asset at time period 0 and put $1 million in, and that's our basis. Now, we're going to go and hold this asset for a while, and either through our adept management and increasing rates and increasing rents and increasing income and shaving expenses, or what goes on in the marketplace, the value of the property goes up. That's our capital gain. So we bought it for one price, and the value over time has increased for whatever reason. Now, that is a non-cash item to us while we own it, but we're going to realize that capital gain, that actual benefit, when we sell the property. Now, because we're savvy investors, throughout our ownership period, what do? Well, you remember that recapture we talked about? Well, we're going to take that recapture or depreciation over our ownership interest, and we're going to shelter our ordinary income. So if our property produces, let's say, $100,000 a year, we'll make it simple. Let's say that our cost recovery is $30,000. We reduce our tax exposure to that $70,000 because that recapture shelters some of our current income. Now, what the government giveth, the government invariably taketh away. So just know this, we're not going to get to keep that. At some point in time, we're going to have to pay for it and disgorge it, and that'll be in the form of our recapture tax later on. So we get to take advantage of it now, and we get to shelter our ordinary income coming out of the property, but we're not going to get to hang on to it. The government's going to want to get some of that back. Now, the other thing we got to recognize is that we can't deduct the value of the land because, as you well know, land never depreciates in value. So the government says that when you buy a building, 25 to 30% of that real property is going to be assigned to the underlying land. So really, the only thing we get to depreciate is the building and the improvements. And when I say building and improvements, I mean the actual physical building, the landscaping, the sidewalks, the parking lot lighting, anything that's not dirt essentially wears out. So we get to depreciate that over our ownership interest and shelter the ordinary income produced by the property. Now, let's just say for the sake of the argument that we get extraordinarily lucky and the market goes up substantially and we get a $2 million offer. Not a bad investment. We bought $1 million worth of property way back yonder, and we've got a $2 million offer. So how does that really break down for us, the investors? Well, first thing we've got to recognize is there's some capital gain here, isn't there? We paid $1 million, and we've got a $2 million sale. So shortly, we've got a $1 million capital gain to recognize. And remember, because we were prudent investors, we took our recapture that we were entitled to for our entire ownership interest until we depreciated the property essentially down to its land value. So we've got to recognize some recapture tax as well. Now, here's one of the reasons why this is kind of important for you to understand as well. Let's say you're looking for opportunities on the marketplace and you find somebody who's owned a property for a really long time. And it's not unusual that people own property for 30 or 40 years. Well, think about this. Do you think maybe their basis is really low on the property? And do you think possibly they've taken quite a bit of recapture over the ownership interest that they've had? You bet. And the property could be considerably more valuable than it was when they purchased it. So now they've got a problem. Because they have no recapture left, all of the income that's produced by that property is fully taxable. There's no shelter anymore. So it would be an ideal situation for them, and we'll talk about this more in a later section, to sell the property and do a 1031 and leverage all of that equity that they have in the building into a bigger, better building and defer the taxes. But let's take a look at how this breaks out now. So we've got $1 million in capital gains, $750,000 in recapture. Well, here's the math. $1 million times 20%, which represents the current capital gains rate, means there's a $200,000 bill. Excuse me. And because we've depreciated the property, our exposure is $750,000 in recapture at a 25% tax rate for $187,500. Now, what's that look like? Well, take a look at this. Here's our combined capital gains and recapture tax bill. First off, $200,000 in capital gains tax, $187,500 in recapture means we only have to write a check to Uncle Sam for $387,500. Now, I don't know about you, but that sounds like a lot of taxes to me. And that's why I say, is it any wonder that people want to do 1031s and why they're so popular? And again, we'll talk more about 1031 tax-deferred exchanges in a later module. But if you understand, you can bury all $387,500 worth of taxes into a replacement property. And it doesn't have to be a huge property to succeed in this. It gives you a great incentive to go looking for another property. And this gives you another arrow in your quiver when you're talking to your customers and clients about what they should do with the proceeds. And here's a fascinating fact, and we'll talk about it later, but if they buy a building, they can literally turn around and refinance the building and pull the proceeds out tax-free. Now let's take a look at, real quickly, that adjusted basis I talked about earlier. Remember I said if we made some capital additions to the property, it would change our basis? Well, here it is. Now, again, I want you to understand what I'm talking about here. We're not going to redo the numbers, but if we go in, and you can see it right here, and we put in an additional $250,000 over and above what we've already got into our property through those capital improvements, see what I'm talking about right there? It takes our basis up from the original basis of $1 million to $1.25 million. Now, you can see almost anecdotally how it reduces our capital gains exposure by $250,000, and it would increase the amount of recapture, or decrease, I should say, the amount of recapture, but the more basis we have because we added that additional capital into the property. What might that be? You could have put new walls on the outside, new elevators, new roof, any number of things. And that's essentially how you'll see the adjusted basis being taken care of. So in short, and this is the really easy part, I mean, what's capital gains? Capital gains is the gain in value for any reason. You bought it at $1 million, it went up in value, that's the capital gain. The tax shelter, which is known as recapture, was that part that we got to take over time and offset against our ordinary income produced in the property. We can't depreciate the property beyond the value of the land. The underlying land never goes down in value. And for our purposes, the only way we can change that is to put in some additional monies, which changes our basis and becomes what's known as our adjusted basis. So I hope that gives you kind of an overall, real quick, down and dirty view of the capital gains tax scenario. You know, and I wanted to break it down and make it as simple as possible. And while this may be the end of the presentation, it's certainly not the last word regarding capital gains tax. If you've got any further questions or comments, please email me at avonromer@outlook.com. Hey, I'd love to know what you think about the presentation. And certainly, if you'd like to hear more, or if there's other topics that interest you, reach out to me. I want to thank you for taking the time to join me tonight. I really appreciate your time and attention, and I hope I made this worthwhile for you and enjoyable. I hope it's at least as much fun for you as it was for me. So anyhow, thanks again for joining me. Hope you all had a great night, and talk to you later in our next session.